folks, Dan Ferrer here with your morning update. So what we're seeing today in the market, we're going to go over what in the world's going on with banking right now, because it looks like there are a lot of them starting to crash. The stock market doesn't like any of this news. On the inflation front, we got some great news there, and if you're a home buyer or you're looking to refinance, you might have a good opportunity because rates are coming down. So let's get over to it. What you're seeing on your screen is basically what I see. So if you're a mortgage advisor or realtor and you want a really in-depth approach to monitoring rates and what the housing market is doing, I have a link down below to MBS Live if you'd like to join that. You get the subscription down below gives you a discount, and you can check it out. But if not, watch me every day because I'm going to go over all this for you and put it into layman's terms. So you're seeing right now the MBS market is, well, you can't really see this. I'm going to show you that here in a minute. But what's in the news today we want to talk about is inflation and some other things. And then we're going to go over what's going on with the banking sector and is the taxpayer going to be on the hook? Now, yesterday I came out and adamantly said no. Well, there was some findings last night and some revolutionary updates, and I'm going to give you that here in a minute. So what you're seeing on your screen right now is the economic calendar for the week. Today we got in retail sales. People are starting to stop spending. Good for you guys out there. So what we're seeing on the screen right now is the previous reading on retail sales month over month was up 2.4%. What was the expectations? Well, they knew it was going to drop a little bit, but they expected it to drop all the way down to negative 0.1, and they hit it right on the button. So we were at let's say it was a 2.5% move in core retail sales, which is really good in this market. In a normal market, you'd say, guys, why aren't you spending any money? But in today's times of uncertainties, people are starting to spend less. That's nothing but good news for inflation, and we can see that in the next piece. Producer price index. What the producer price index is basically, remember yesterday we went over the CPI, which is the consumer price index, which is consumer inflation. Just think of it that way. How much you and I's prices that we're paying at the grocery store and at the pump and everything else is going up. Okay, so what we follow, if you try to backload that and see, well, okay, is this going to continue? Well, let's look at the producer side of the equation. Are producers' costs going up? Okay, so what you see on your screen right now is the producer price index was up 0.3 at the last reading. It's down minus 0.1 this time. Also great news because that's telling us the prices producers are paying are starting to come down. And as long as they don't start price gouging us additionally, that they should move those price declines over to the consumer side of the equation. We should start seeing prices starting to ease, thus lowering the inflation. Great news that I think of is right the next one, retail sales. Now, this is proof that people are starting to stop spending or slowing down their spending. The previous reading was spending was up 3.2%. The expectations were -3. It came in at -4, that's bad English, -0.4. Okay, a big move, big. So we have people spending less, producers' costs are starting to come down, and then sales, people are starting to buy less. And then we have on the other front, crude oil. Last reading, we had a negative 1.6 billion barrels of oil. Now we have in excess of 1.5. So about a $3 billion barrel adjustment. So you're going to start seeing oil prices dropping. And I've been calling I didn't call it, but people have been calling oil in a bear market. And we're going to look at that here next. So what's going on in the stock market? The stock market doesn't like any of this because they're focused in on banking. And I don't disagree with them. Hold on one second. So here's what you're seeing right now. On the stock market, the Dow Jones is down 600 points. So this is where the volatility comes in. Remember 2 days ago, I think the Dow Jones was down 500, and then yesterday it was up 300, and then today it's a seesaw. So now you can see why people aren't really confident in the stock market right now. People are starting to pull out, thus equals flee to safety. I'm going to get there in a minute. So you can see the S&P is down quite a bit, Nasdaq's down quite a bit, the VIX is up, meaning people are nervous. But look at this, gold is up because the fear of inflation is still there, but oil is down 3%, over 3% today alone. So it's just plummeting right now. That's nothing but good for us because it's going to help all over the place. Think, what you pay at the pump is going to go down, or it should go down, as long as we don't, like I said, continue to get gouged by the energy companies. That should go down. Think of everything that uses oil. We hate to say it this way, but you got tractors that plant the food, tractors that pick up the food, machines that run on oil, and might, even if you plug them in, they have oil in all the mechanisms. How do you process that stuff? Well, with machinery. How do you get it from place to place? Trains or trucks. All this stuff uses oil. So if oil drops down, you're going to see things all over the place starting to reduce in costs. Okay, so you see that part of it. Now here's the intriguing part. Here's what we're going to get into the banking sector. So inside the legal loopholes of the U.S. regulators used to bail out SVB depositors. Okay, so yesterday I said that taxpayers are not going to be bailing out the bank. Okay, but there was some findings last night, and we're continuing to do research on this, and I'm going to read a lot of this to you. I usually don't read verbatim, but I'll put everything down below. But I want you to pay attention to a few areas here. Okay, so I'm going to skip down through, and there's a law called systematic risk exemption. Okay, it's basically on the books that the Federal Reserve and people can come in to help save banks. So basically, here's it broken down in a nutshell, and I'll just read verbatim. The law, which limits the FDIC powers to guarantee depositors, emphasized that the agency must choose the least costly method, even if doing so inflicts losses on failing banks, uninsured depositors, creditors, and shareholders. Okay, so that's part of a law. All right. However, the exception invoked 4 times in response to the 2008 financial crisis and pared down under the Dodd-Frank Act can extend reimbursements to uninsured depositors when the U.S. Treasury Secretary decides that the additional FDIC assistance would lessen the seriously adverse effect to the economies or financial stability otherwise bound to happen under the least cost response. So in here, I want you to pick out Dodd-Frank, okay? Who's a member of the board of Signature Bank who's failing right now? Barney Frank, who wrote this act. Okay, so even legislation sometimes doesn't help, or he created this bill, then he goes to a bank and the bank fails. He's on the board. He has basically a fiduciary responsibility to the success of that bank, and he failed. Okay, so there's probably a lot more that we're going to find out behind the scenes on that. Let's see. Where did we leave? To use that authority, the secretary must first obtain authority authorizing votes from 2/3 of the FDIC board and 2/3 of the Federal Reserve Board of Governors, plus consult with the president. So you're going to need the FDIC to approve this. You're going to need the Federal Reserve to approve this. And then you're going to need President Biden to basically give his okay. I think all that is in the works. From a lot of this, it seems like they worked on the back end and they've already resolved some of this, but they really haven't come out yet and told us the full effect of this thing. So here's what's in the works. But here's some good news for you guys. No losses, President Biden said this the other day, no losses will be borne by the taxpayers. The president told reporters, instead, the money will come from the fees the banks pay into the Deposit Insurance Fund. That's DIF, Deposit Insurance Fund. It's a fund right here that banks pay into from earnings and some other things to put into this reserve as like an insurance account. Okay, so let's go down through here, and there's more to this. I'm not picking and choosing what I want you to say I want to tell you guys, because I'm going to post this down below so you guys can do your own research. With the DIF, the funds pay out the depositor's loss is primarily funded through quarterly assessments on insured banks and to lesser extent through interest earned on investments and assets recovered through liquidation. Critics say that because the fund is ultimately backed by the full faith and credit of the federal government, taxpayers are taking a risk when the government chooses to make uninsured depositors whole. The FDIC is also authorized to tap on federal lines of credit if DIF runs from short. So what will happen is there's this insurance fund that the banks can use if they're insolvent to kind of get all their shareholders and depositors paid in full, okay? And it's paid through, or it's funded through bank earnings and some other things. So our deposits are in the bank. They're using that as investments and so forth, and they're using some of those monies to put in and create this thing. The good news is, and it's going to be down through here, trust me, there's some good news here. According to RICS, it's a publication, taxpayers would be on the hook only if the FDIC becomes insolvent, which happened following the 1980 savings and loan crisis. I was around, but I was a kid. That cost taxpayers $125 billion. So think of $125 billion in the 80s would be probably $500 million right now, $500 billion right now. So that was a lot of money. One former FDIC director who asked not to be identified, obviously, told Yahoo Finance that the risk to taxpayers in insuring Silicon Valley Bank and Signature Bank's customers is remote because the FDIC is nowhere near a need to access the FDIC line of credit. For the fourth quarter of 2022, the fund reported a $2.8 billion increase in just the fourth quarter, $2.8 billion increase in its balance sheet to $128 billion. So they're basically saying assessment of the total value is $2.1 billion, counting funds, they have $490. They're well ampled funds. But if every bank in the whole country crashes, it's not going to have enough funds, but it shouldn't happen. So please watch the news that you have, because they're going to say taxpayer monies are paying this. Well, if all banks go out, the FDIC will be insolvent and so forth. You guys will know the difference, okay? Please share my videos if you would. Have other people find this, because we're not Fox News. We're not CNBC. We're not, other YouTubers out there that just pumping, so you'll get the clicks. I'm your unbiased opinions, because guys, I have no skin in the game here. I'm a mortgage advisor. Okay, I'm not in the stock market. I'm not in the bond market. I'm not in this. You don't consult me. I'm not a financial planner. I'm not licensed. I don't do this. I don't want you to follow my trends. I just do this as educational purposes, and I give you my experience and what I'm doing, so you can at least look at it and see, maybe it's a good, you like what I'm doing or don't like what I'm doing. That's fine, but I'm just showing you my experience, especially having 34 years in the banking industry. Okay, so that's basically that part of it. So that should be, everything should be okay. But we never know what tomorrow's going to bring. All right. So somebody asked me yesterday, why don't, mortgage companies and other companies, use Bitcoin more? Well, and I wanted to address this today. If you go through here, this is what the value of Bitcoin has done since over the last, say, year and a half. Over just not too long ago, and you can see that right through here, Bitcoin was trading at $65,000 a coin. Okay, that's November of 2021. Not too far from there, we are today at 24. So that is about a $50,000 drop. So you say from 65 to 24, that's a huge drop. That's why people don't use it. I don't have the confidence. I would never want to get paid at this time in Bitcoin. A lot of athletes did it, and they're probably looking themselves in the mirror now and saying, what in the world did I do? So that's it. Here's where the dollar's been over the last, let's just say from 2021. It was that last chart. So from 2021, where the heck is it? This doesn't even go that far. But this is the price of the dollar. So you can see the dollar is, how in the world did this take place? I just pulled it up. Well, the dollar's a heck of a lot more stable than Bitcoin. So now you wonder what in the world's going on with the mortgage rates, because Dan, aren't you a mortgage advisor? Well, yes, I am. Thanks for asking. So what you're seeing on your screen is basically what's going on with mortgage rates. Okay, so what you're seeing on the screen right now is it says 30-year UMBS 5.5. I can't get the 6.6 coupon up here, but this is the bond that trades on Wall Street. It's not the security bond. It's not the FDIC bonds. It's not the anything else. It's a UMBS mortgage. So it's basically a mortgage bond, specifically mortgages. Okay, this bond is what dictates your mortgage rate. Believe it or not, it's not the 10-year treasury or any other treasuries. It's this right here. It's like in the news because people are starting to flee to safety. So yesterday we talked a little bit about flee to safety. What does that mean? Well, it means people that are getting hammered right now in the stock market. The Dow Jones down 500. It was down 2 days ago. It's been down, I think it was down 30% last year. People finally said, I can't continue to lose money. So I need to move my money into something safe. Well, what a lot of people are doing right now, they're putting it in, even in CDs or mortgage bonds or some other kind of bonds, because they have, they have a yield. In most cases, they're giving you better yields than you're getting in here, and they're giving you a lot better yields than you're just getting in your savings account. And that's why a lot of people are pulling their money out of the banks, because their savings rates aren't paying anything. You can move your money somewhere else and even get a CD at 4 or 5% right now. So everybody's starting to pull their money out of investments and other things, putting them into more secure vehicles, and And that's what it means by fleeing to safety. Okay, so the markets are liking this because people were fleeing to safety. What's going on with mortgage rates? Well, here's what's going on with mortgage rates. This is where rates closed yesterday, and this is based on Mortgage News Daily. They post this this chart every day and throughout the day. So if you want to check out this, you're a mortgage advisor, you're a realtor, want to really keep a tune in on what's going on with mortgage rates, click the tab down below. You can subscribe to this. It's free. It's free. But if you want this, plus some other commentary and everything else, please click my subscription down there. It's my newsletter. We don't sell it. We don't solicit you. We just, you use that for your knowledge. And that's what we do. So if you're in the market for a mortgage, that's what I do. So if you're out there and you need a pre-approval, you need to get, you want to look at maybe a refinance. Maybe you closed 2 months ago and your rate was 7.5 and now you can get 6.5. Maybe I'd look into that. You can refinance, believe it or not. Some people are looking to pull out some monies on a home equity line of credit to pay off some high interest rate credit cards. We can do that as well. If you're looking for a reverse mortgage, that's one of our wheelhouses. We love doing reverse mortgages, and I can assure you we can save you a lot of money too if you're looking for a reverse mortgage. So if you want to find out more about me and my team, we have a lot of information down below that you can check us out. Give us a call, doing one-on-one consultations to advise you guys how much you can afford on a house or what your options are, and that's it for now. So that's my report for today. I will be back today at 3 o'clock live to show you guys what we do behind the scenes to ensure you guys get the best rate in town without shopping on your own, because we can do that for you. So thanks for watching, guys. All I ask you to do is, if you find value in this channel, give me a thumbs up, subscribe down below, hit the bell every time I post a video. Make sure you don't miss it. Take care, guys. I'll see you at 3 o'clock my time. That's Central Standard Time. Just make sure you're on the right time zone. Take care, guys. See you later.